Hello and welcome to this overview of the challenges today for Treasury management and 10 key drivers. Treasury is the name given to the department that manages the financial inflows and outflows as well as other market risks of a firm. Among the top concerns of corporate treasurers gathered from various independent polls of corporate treasurers are as follows. Financial risk management, the ability to manage FX, interest rate, commodity, and other market risks. Liquidity and debt management. In the light of tighter capital and balance sheet restrictions, banks are no longer the surest form of funding. And managing and overseeing banking relationships. The unsettled banking environment is causing more and more companies to seek out alternatives to traditional bank financing, such as the bond market. Companies in the West are seeking out bond financing in record amounts. This is now becoming more important in Asia as well, as local bond markets grow. Last year, there was record corporate bond issuance in Asian markets. In addition, spread compression has driven cash-rich companies to explore non-bank instruments for added returns. Credit issues and the experience of the global financial crisis, along with yield compression, are driving tension between the search for return and caution about where to place excess cash. Companies are no longer content to place all their business with one or two banks after the disasters of the GFC, the global financial crisis. Companies are increasingly turning to market instruments for short-term investment of cash. For banks, Basel III has increased capital requirements and imposed new leverage ratios and liquidity constraints. The increase in focus on Tier 1 common equity as the new gold standard for capital. The LCR, or 30-day liquidity coverage ratio, and the NSFR, the net stable funding ratio, will be implemented in full, though there are currently delays and some backpedaling. There is also a new leverage ratio of 3%, which is a new rule for most banks that will require substantial analysis. Fair value accounting rules have been expanded to try and bring transparency to the balance sheet, both on and off. There are also differences between GAAP and IFRS which need to be addressed. Accounting for these changes has impacts on P&L and capital ratios for non-financial corporates.